Good evening and welcome back to Be Rich. My good friend Shashwat Swaminathan and my nephew is here and we are going to discuss what Uncle Warren has done. It's a bit of complicated deal. Whether Uncle Warren has made the move or the company which he is bought into has made the move is something which we have to discuss. And this is a very interesting thing. This is a very interesting piece of development, not discussed much anywhere. And I discussed in this very channel how Buffett bought Alchemy. Alchemy was another mini Berkshire Hathaway which he bought for cash for $12 billion. I think he's sizing up another Alchemy. Let us take a look at it. Shashwat has done a deep dive into it. He will tell you what it is. And it looks like a perfect fit to me. And if there is a big crack in price, I am sure Warren will swoop in. Tell us some details, Shashwat.
Right. So the company which we're talking about today is called Markel, and it's an insurance company, and they specialize in a specific type of insurance called excess and surplus insurance.
What is excess and surplus insurance?
So excess and surplus insurance is basically insuring for stuff which isn't your regular type of insurance. So your really rare types of calamities which happen, they insure for that. So your risk is really hard to place. So that gives them a moat of sorts because not many insurance companies, at least in the US, try to venture into a place where risk is hard to determine, right? So coming to it, their metrics, these are their metrics. Their CAGR is 11% over the past 5 years. For an insurance company, I think that's quite high. And they in the first quarter of this year, they increased their insurance premiums collected by 17%. Premiums earned, sorry. So this basically beat inflation. They beat inflation by miles, even though the Fed revised its inflation numbers by to 9.1%. They beat inflation, and their combined ratio is over the past 5 years has averaged 99%, and only once in 2017 had they crossed 100%. And the combined ratio for those at home is basically your claims and expenses divided by the premium collected. So basically, are they
what is it? Claims ratio is?
Combined ratio is claims and expenses divided by premiums collected. So
and theirs is at what percentage?
Their average over 5 years has been 99%, and only once in 2017 had their
above 100%.
Above 100, 101.
So they are always making an underwriting profit of at least 1%.
Always. And this is only from their insurance business. And moreover, now this might seem like so if you look at it from a surface level, it might seem like 1% is not much. But then what you have done, what Warren Buffett has mastered, and what you have to understand about an insurance company is the float. The fact that he makes how much ever percent on that float in a given year, that is added to his profit margins plus whatever capital is allocated apart from that in terms of retained earnings, which has been put into investments. So that is where his 11% is coming from, and he has been able to constantly jack up his insurance premiums whenever he wanted to, because again he targets a segment which isn't targeted much. Not many people want to insure black swans. He is saying that he'll take the bet, and over the past 5 years he's only once made an underwriting loss. So I'll run you through his portfolio, Markel's, and so Markel's biggest so it came in the news because it was said that Buffett bought into Alphabet and Shopify. But if you actually look at the Buffett deal, Markel, although they own $384 million in Alphabet and $323 in Amazon and $1.9 million in Shopify, yes, they're big numbers, but their biggest holding is Berkshire stock, both A and B. If you combine both of them together, it comes up to a whopping $1.1 billion. And Warren Buffett has basically bought 3.1% of Markel. So he's bought 3.1% of this 1.1 billion pie.
So it's basically buying back his own stock.
Exactly. And that's what I figured out after I looked at Markel's holdings after that Motley article which you sent me for a lead. So I feel like the focus of this conversation should be more on him buying back
his own
stock for cheaper, because Markel is valued at a lower PEG, lower PE, as well as a better deal overall in terms of valuation, because Berkshire has recently gone up in price.
So he is basically going to swallow his own company
for way cheaper than market price.
And
that's what people don't realize, because they don't realize that Markel has $1.1 billion in Berkshire. So if you're buying Markel, you're buying Berkshire.
Okay.
And their entire portfolio is only worth almost 40 or 50% of their portfolio is in Berkshire.
Okay. So he's basically buying back Berkshire cheaper.
He's basically buying back Berkshire, and you can say that yes, he's also getting an eclairs type free chocolate in terms of Alphabet and Amazon and Shopify. And he said he missed the bus and all that, and now he's getting it for much cheaper than market valuation, because Alphabet, if you recall, was 19 or trading at 19 to 20 in terms of PE, and Amazon was trading at 56. So he's getting a freebie on Amazon and Alphabet, but mainly Uncle is buying back his own Berkshire stock. And the thing with Buffett type deals is people who slander him usually don't realize that there is more going underneath the deal which he's made. So even the past few deals he's made, all of them surface level might seem like very mediocre deals. But as soon as you spend 10 minutes digging into what he's doing, you realize that he's doing something much bigger than what you think. So indirectly he's buying, I don't know if he's extinguishing the stock, right? It's a buyback.
It's a basically buyback. He may not do it,
Yeah.
but it's basically a buyback.
Yeah, and the market cap for Markle is $17.8 billion. Uncle Warren has much more sitting in free cash flow. He's sitting on much more free cash flow, so you can buy it in an instant.
If that company agrees, he can buy it and swallow it.
Exactly.
And if he buys it for 17 or he buys it for 20 billion,
Yeah.
giving them 3, he's already getting back 1.1, which he'll extinguish.
Yes.
So whatever he is buying back, 1.1 will be written off.
Yeah, and what's more is that even if he gives that $3 billion in excess, he'll buy back Amazon, Google, and Shopify, and Walt Disney, and all these other companies for dirt cheap. $3 billion, he gets those stock for much cheaper. So I think that makes up for how much ever if he...
Plus he gets into a moat-like situation.
Because of E&S.
E&S.
Yeah, and that adds to his insurance business. So I'll give you a quick run through of the company. Markle was founded in 1930 as an insurance company, and since then it has been only recently, although has it come into its own. In the past 5 years has been its record-breaking 11% CAGR for an insurance company. And in the
What
year,
was it doing before that?
before that, they were still doing insurance, but also they were doing other retail businesses over the span of 1930 to 2021. So, but now they've mainly pivoted into their insurance business.
They have sold the rest of the business.
It's very small. From what I could see, there's not much to write home about. Their profit in 2021 was $2.129 billion, and
So it's basically you're looking at 8 times.
sorry, their free cash flow is $2.129 billion.
So it's at 8 times, the market is valuing it at 8 times
Yeah.
free cash flow.
Yes. And so this is a brief of the company. So these are the questions I have for you now. First off, what is a float?
A float is something in which you get the money, you get to keep the money for a period of time, and you get to pay out over the expenses. In this case, you pay out 99% of the expenses over a period of 1 year. But during that period of 1 year, you will be acquiring new float. So float is a money that is permanently with you. While I am paying out these claims this year, I take money today,
Right.
and I pay out the claims right through the year.
The new premiums will come in and add to your float.
Will come and add to my float.
Right.
So the money that is permanently lying with me is called a float,
So
which is free to invest for me.
So it's almost a situation where you rarely get caught out if you
No.
play your cards right.
Yes. Unless he makes a big, if he makes a big investment boo-boo,
Right.
then that $17 billion, that whatever is his investment portfolio
Right.
of $3 billion is on the hook.
Right. So this is more of a question from the past, but why did Warren miss the bus on Alphabet and Amazon?
Because Warren does not invest in businesses he doesn't understand.
Circle of competence.
Circle of competence, and he is very clear on that.
Right.
In fact, he said in an interview along with Charlie, they were using AdSense to advertise.
Right.
They were using
I
AdSense
think
to
it was with Becky Quick.
Yeah, so they were using AdSense to advertise.
Yeah.
And they found it useful. It was in Geeko, it was giving them lot of revenue. Still, they didn't understand the business and they didn't go for it.
Right.
Had they gone for it, it would have been a great move.
Yeah.
And in a way, they were also helped in going the Alphabet public issue also. So it was a bus that he missed. Amazon, I don't think later he would have made a realization, but he would have never invested in a company which kept making losses for so long. No.
Right. But I think now he has a very small stake in Amazon.
Yeah, this is after he's seen the profits in digital.
Right. Right. So
The next question they will ask me is why did he invest in Apple? He looks at Apple as a consumer franchisee, not as a technology company.
Right.
Most people don't see Apple as a technology company, they see it as a franchisee. So if you see it as a franchisee, the people who are using Apple will upgrade to an Apple phone. You will buy an Apple Mac.
Right.
You will buy the next iPad.
Yeah.
You're not going to leave that and go to some other company.
Yes.
That itself is a huge franchisee. The other thing is people use iTunes.
Yeah.
Right? These are huge franchises. He saw it as a franchisee business which he understands very well. He didn't see it as a technology business.
But now Buffett is looking through the same lens with Amazon.
Easy, something which he has not given out to interviews. I'm sure he'll tell us after after he's bought a big position.
Right.
He's not talked publicly much about Amazon.
So also I want to understand how Buffett makes use of a float. I mean, he says Markle is a baby Berkshire. So what does he mean by that, and why, and how do you think a float is important for someone like Warren Buffett, who's a capital allocator?
See, Warren Buffett started as a hedge fund manager.
Right.
The problem in being a hedge fund manager is you get caught out when you don't want to be caught out. That is, people want to give you money to buy when there is nothing to buy.
Yeah.
And people want to take out money when there is lot to buy.
Yeah.
Right. When the market tanks, people want to pull out money, but actually that's the time they should be putting more money.
Right.
At the same time, when markets are extremely high, they will load you with more capital. See, he wanted to get out of it, and he got out of it very early. And what it does is, I have the float. That means I am an unlimited hedge fund. I have enough cash flow coming regularly, which I can allocate.
Right.
So my float keeps increasing. Therefore, my allocatable capital keeps increasing. And some of these businesses I own fully.
Yeah.
He started by being part owner of businesses, but with CS Candy and blue chip stamps, he became complete owner of stocks. So they started throwing cash flow, which he had to invest again. So he is basically looking at businesses which give him free cash flow. His insurance is giving him a lot of free cash flow.
Yeah.
So is CS Candy, now very small, but at that time significant. And so did blue chip stamps, which is now defunct.
Right.
So he basically looks at businesses which throws out free cash, which he is in a position to invest. And he has a lot of cash at always. And all the time, this time people said he deployed $50 billion even before the market went down. Big $11.5 billion was to buy Alchemy, which is his own baby company. Next, he's bought a dyeing industry, that is HP, like what he did with Duracell. Third, a major portion of that money has gone to buy Activation Blizzard, which is a special situation which he is going to exchange for cash when Microsoft does the deal.
Right.
So this is what I look at it.
Right. So that's all I have for you today.
Okay, so I think you guys got a good idea of how Warren Buffett thinks. Thank you for watching Be Rich. If you like this video, kindly subscribe to our channel and turn on the bell notification. Consider sharing this episode with your friends and relatives. If you do not turn on the bell notification, you will not be notified every time we put out a video. Once again, I thank you for your support for Be Rich. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.